Hi, everyone. Welcome. I'm Michael Episcope, co-CEO of Origin Investments, and this is the IncomePlus Fund webinar. And I'm here today with my co-CEO, co-founder, and friend, Dave Scherer. Welcome, Dave. Always great to host these with you. The title of today's webinar is Riding the Resurgence, and we titled it that way because we are starting to see the early signs of a market recovery. Capital is coming back, transaction volume has increased, and fundamentals are beginning to improve. So it's nice to see our forecasts start to come to fruition, and it's even nicer for it to show up in the fund's performance. We have more than 700 registrants today, so thank you for registering, attending, watching this in the recording. If you are an existing investment partner, welcome back, and thank you for partnering with us. If you are a prospective investor, thank you for tuning in, and we hope you'll eventually become an investment partner. And I want to make a shout out to a very special attendee today. My son, Sean, will be watching the recording later this afternoon. He's actually at work right now, but he's watching it with the intention of investing in this fund. And I couldn't be more proud of him and also humbled by the fact that he wants his first investment to be here at Origin. The goal of this webinar is to provide you with insight into how the fund is performing and why it will continue to outperform in the future. I'm going to cover the state of the fund, how it's performed over the last several years, and give you some guidance on fund performance. Then I'll hand it off to Dave. He is going to cover a few of the fund's deals in detail and finish up with the macro environment. Our portion should last around 35 minutes, maybe a little bit over. And after that, we are going to open it up for everyone's favorite portion, which is the Q&A section. So let's jump in. See in front of you, this is the title slide, Riding the Resurgence. And here is slide one. So I'm going to start with some of the kind of basic fund overviews for those of you who may not be as familiar with this fund in Origin. The overarching goal of this fund is to provide tax-efficient income and appreciation in a single vehicle. The fund, it engages in three strategies only in the multifamily sector. So the first is we acquire and hold core stabilized properties. These have the benefit of producing cash flow appreciation, and one of the most important benefits of providing the fund with tax efficiency, depreciation tax benefits. We also invest in ground up developments. This is what we call our high margin sleeve, and it's limited, excuse me, to 20% of the fund's capital at any one time. And the last thing we do is we make loans in this fund. These provide income, safety, and stability. And all of these strategies, they work together to achieve the fund's objective of generating a 9 to 11% annualized return, which is inclusive of the distribution yield that today stands at around 6.45%. This is a private REIT, so anyone investing will receive a 1099 for their tax filings. The unit price, I'll go into that. That's on the right-hand side there. It stands at $11.17 today, and that's actually up about 8 cents from last month's price of $11.09. And this is kind of what we were alluding to when we said riding the resurgence. But this is a pretty significant jump considering that the unit price has largely been fairly flat for the last 6 months. And it's attributable to improving fundamentals, which is leading to higher asset values across the board. Leverage is extremely conservative in this fund at 56%. And I would say in the world of real estate, this is a lower risk fund. And there's one major thing I want to cover. And I said earlier that I would give you insight into the fund. And that's our goal here. It's not just to give you data and read what's on the slide, but this will really help frame the entire webinar, because we often get the question, what is the sustainable competitive advantage of this fund? In other words, why has it outperformed and why will it continue? And I'm going to distill this down into three things. The first is our strategy. We actually have three distinct strategies in the fund. We build, we buy, and we lend. And each one could be in or out of favor depending on where we are in the real estate cycle. We have the choice of doing them all or none of them. If properties are trading 30% above replacement costs, then you're going to want to develop to capture that margin. If properties are trading below replacement costs, then you're going to want to buy instead of build, because there is no margin when building. And if you run one strategy, you really have to invest that money in that one strategy. You don't have a choice like that. So, for us, this is exactly how we've been investing the last 4 years. And I don't think many managers can say this, but we went 4 years without buying a deal. We lent and we engaged and invested in ground up development. And that's how we sort of sidestepped the bubble and generated positive returns in one of the worst real estate markets in the last 20 years. We have the tools to be agile in different market conditions. And if we were a fund with a single strategy, we couldn't do that. The second sustainable advantage is that we are multifamily only, right? Multifamily, first of all, has produced the highest risk-adjusted returns within real estate over the last 40 years, one of the safer asset classes, need-based. But I think more importantly, every day our team wakes up, they are thinking about one asset class. It's about operational excellence. So our processes, our technology, our data, all of our information, past decisions revolve around this one single asset class. And I think it's one of the reasons why we've never lost money in this sector as well. The third thing, the structural advantage of this fund, is that it's perpetual and open-ended. And what this means is that we buy and hold assets. You can get out of the fund and redeem if you want to, but our job is to maximize the value of the investments and run the fund in the most tax-efficient manner we can. If you engage in a buy, fix, sell strategy, you are taking a tax-efficient asset and actually turning it into a tax-inefficient asset. You are giving up the ability to produce passive income as well, which is a huge benefit of owning real estate. In fact, cash flow historically has accounted for around 30 to 50% of the long-term returns in multifamily real estate. And the only way you get that benefit is through a buy and hold strategy. And I often think of Morgan Housel when it comes to investing. He wrote the book Psychology of Money, and he has a great quote that I think about quite often. But he says, let time and tax efficiency do the heavy lifting when it comes to investing. In other words, you create wealth by investing in productive, tax-efficient assets and holding them for long periods of time. Jumping into the next slide, I'm going to talk a little bit about the distribution yield. I had just talked about how cash flow is 30 to 50% of long-term returns in real estate, and this fund is very similar. Right now, the distribution yield stands at 6.45%, but more importantly, it's about the after-tax distribution yield. And we are generating a 6.32% post-tax distribution yield. So think about that. There's not much tax on this, and you would have to earn more than 10% on another investment that's taxed at ordinary income rates to take home the equivalent of 6.3%. And that's just at the federal level. So if you're in a state that has income taxes, you have to earn a lot more than that. So that 6.3% is the pre-tax equivalent of 10% on another investment. And the reason the post-tax returns are so high in this fund is because of the benefit of depreciation. Depreciation shields taxable income, so you keep more of what you earn. And this is especially important for those who opt into the DRIP, the dividend reinvestment plan in this fund. So if you don't need income, you can actually you can compound that income and just continue to accrue it into your position on a monthly basis. But most importantly, you are not going to get a huge tax bill at the end of the year in this fund because the taxable income is very, very small. It's shielded by that depreciation benefit. This fund, we call it the all-weather fund, and you can see in front of you what the growth of $250,000 looks like from the fund's inception. And when I look at this chart, I think of the saying, there are decades when nothing happens and years when decades happen. And we've gone through COVID, we've gone through unprecedented Fed rate hikes, we've seen banks collapse, we've seen some of the highest inflation in 50 years, most recently tariff announcements, and these have been some of the toughest years to navigate in real estate. But here are the fund's highlights during this period. We produced positive returns in 71 out of 76 months since inception, and that's 95% of our monthly returns have been positive. We've had 76 months, 100% consecutive months of distributions where we've actually met the distribution yield. We've never shut that off. And the last one is we've increased the distribution yield by 20% over the past 3 years. So that's our goal each and every year, is to increase that distribution yield for investors as well. And so that $250,000 would have grown into roughly $400,000 in what I would characterize as a very, very difficult market. And the other thing, each of those vertical lines, you can kind of trace back to my receding hairline. I had a lot of hair, back in 2019. Each one of those, I go back a little bit more each and every time. Let's jump into the next one here. This is our track record and really how we stack up against the competition. We benchmark everything we do, whether it's our returns or our property performance, how we're capital raising. Everything has to be benchmarked against how you're doing against competitors, right? It can't be in a vacuum. You don't know whether 12% is good unless you see what the competition is doing, right? 12% might be great, but not if the competition is producing 20. And so like in this chart, if you go from left to right, you see the 1-year returns on the left, and those haven't even been close. We produced a 7.8% return over the last 12 months, and the closest competitor was Hines at 4.9%. 3 groups in the benchmark actually lost money this year. The 3-year returns generally tell the same story. We generated a 5.8% return, while most of our competitors showed losses during the same period. And the 3-year period is really what I would consider the most important period, because this is the real estate recession period. And it shows which managers can actually protect downside when the market goes down, and who can capture upside when the market goes up. But unfortunately, when the market goes up, it's usually the manager who's taking the most risk that produces the highest returns, and that tends to not have a great ending in those situations. So you have to compare returns at both ends of the spectrum when evaluating managers to understand who can deliver alpha in those situations. The 5-year look back on the right-hand side tells a very similar story. We've generated a compound annual return of 10.2%, beating 7 out of 8 of our benchmark competition and matching our return goal as well. We're incredibly proud of our historical returns. I know Dave is, the entire team. But more importantly, from our standpoint, we've personally benefited through our own investments. Dave and I are individually the largest investors in this fund. And I actually just increased my position by 10% last month. I believe in the recovery, but there's also, and you should know this, there's hidden upside in this fund. And I've mentioned this on previous webinars. Well, we have around $12 million of trapped value in the form of accrued interest that is owed to us, but has not been recognized at the fund level. Because our policy today is that when we have a loan that is above 90%, we do not continue to recognize any income above that level. But make no mistake, that income is owed to us, that interest has accrued, it's owed to us by the developers. If we are able to recover this accrued but unrecognized interest, which I believe we will be able to do, this will add about another 25 cents to the unit price very, very quickly. So it's an upside call in the fund. This next slide shows our progress in converting the fund, tilting it from debt to common equity. And if you've been watching this webinar for the last year, then you know we've been talking about reshaping this fund from our webinar a year ago, which was it's time to go on offense. And the goal is that we're going to reduce the amount of debt in this fund and increase the common equity over time. And so in June of 2024, the fund was 66% tilted towards debt investments. And that was by design to get us through the volatility of the last few years. But common equity positions, they stand to benefit the most when assets appreciate. So we've been slowly tilting the fund back in this direction, and we've been making some progress. Today, you can see the portfolio. It's about 42% common equity and 58% debt. And our goal is for the portfolio to be roughly 60% common equity and 40% debt by this time next year. And it really all depends on how much of our preferred equity positions pay off in the next year, because that money will be reinvested into new deals in the common equity position. So as developers refinance, as they sell their assets, as they pay us off, that tilt will happen fairly quickly. And I think this is kind of conservative. So the last slide I'm going to cover before I hand it over to Dave is an evolution in our valuation process. And more importantly, I should say just an improvement. And we've moved to what we would categorize as a more robust valuation policy. We hired a firm called Altus. They are largely considered the best fund valuation group in the market. And we've always had a comprehensive valuation process. We've shared it here on many occasions, but the biggest difference now is they're valuing our portfolio of common equity assets on a quarterly basis versus annually. Before we did this, the policy just last year, we would do internal valuations throughout the year on our common equity investments and then corroborate those values with a year-end appraisal process. So this is definitely more robust for all investors. And this was asked for by some of our larger and more sophisticated investors who were pushing for more frequent valuations. But the valuations themselves have not changed. We're also working with Altus to adopt a framework around our preferred equity positions. They have historically used what we call a bond-like framework, which is a discounted cash flow model. And I also know from being on the road, many investors have also asked for a framework like this as well, because when yields go up, if the 10-year Treasury goes from 3% to 5%, bond values go down. And if the 10-year Treasury goes from 5 to 3, bond values would go up. Well, preferred equity is a debt-like instrument, but it's also nuanced, right? It's not as simple as a debt instrument, right? If you lend to a ground-up development at 12%, and then rates go up and new issuance is at 14%, you would think your position is worth less. However, if that investment property becomes stabilized and you're making 12% at 70% loan to value, you are likely making an above market return on that position for that level of risk. So again, it's nuanced. Our team is going to be working hand in hand at Altus to get the valuations correct in this fund. And this is really a good thing for all investors. And it was, something we were happy to do. And we're always looking to improve every process here at Origin. So that's it for me. Dave, I'm going to hand this over to you to take it off into some deals. I will fast forward for you. So all yours.
Thank you, Michael. I was thinking this morning, we've been working together 20 years next year. So thanks for being a great partner for an awful long time. And let's do it for another 20. You still have some hair left. So we got some to work with. I'm going to cover in my section a deep dive into some of the assets in the fund, both equity and pref. And then I'm going to cover some market conditions. And I'm going to use it kind of within the frame of what drives real estate values. And I'll take you through why Michael and I are pretty excited about the coming years, as well as, and he touched on this, we're pretty proud of our performance in what's been a 3 to 4 year real estate recession. The returns on this fund don't really show that, but the reality is it has been. So if you were wondering how the fund would perform in a recessionary environment, you've seen it. Like, this is what it'll do. It's done anywhere from 6%, 8% in that range. There are worlds where it'll do low teens, mid-teens, in my opinion, in a tax efficient way. So I'm excited about the fund as well. First fund asset I want to cover is Rise Charlotte. So Rise Charlotte is transitioning into what we would characterize as the stabilized phase. We refinanced the asset on the 5-year fixed rate debt. That's a big goal for Michael, myself, everyone at investment committee. For those of you that have been partners for a long time, we were in the Wall Street Journal when we hedged a lot of our interest rate exposure in January of 2022. We did that through swaps and swaptions. The easier way to do that is just to refinance construction loan, which tends to be variable, into fixed rate loan. And In this case, it was 5-year debt. In other cases, you'll see we do 10-year debt. We're exploring HUD debt. So anything that's capturing fixed debt over long periods of time is good. And it's mitigating inflation and capital market risk when you do that. Leasing momentum has been strong, 32 leases per month. That's really high. Just to give you a frame, when we model, we typically model 15 to 20 leases a month. So if I'm saying there's been 32 or in April there was 39, I just want to provide a frame that's very strong leasing momentum. Current status, 87% leased, 93% current occupancy. And then operational wins. These are, our goal is always to try to maximize cash flow. So anything that we're doing, if we're adding guest parking, on-site mini market, we're talking about adding vending machines now across the portfolio. If you think about our buildings, those are places where we can derive revenue. And so you have to do that in a way that adds value, but you also want to continue to watch cash flow going up. And that's one of the primary metrics we measure is quarterly and annual year-over-year cash flow to property, because that's a function of all these ancillary revenues plus occupancy multiplied by the amount of rent at a property. So I'm gonna switch the slide and move on to Reverie Belmont. Reverie Belmont, now again, we refinanced here with 10-year Freddie Mac fixed rate debt. And in this case, we were able to pull cash out, which is great for the fund. It's also it's a very good sign that we created value during the construction period. And when you refinance, you're able to realize that value. So we're happy with that result. And again, it provides liquidity and protection because we've moved to a fixed rate. Leasing velocity here is 81% leased. And here I just want to start this notion of concessions and maybe take 1 minute talking about rents versus effective rents. So rents are actually where we modeled them or higher, but we're having more concessions than we modeled. And this is true in a lot of these markets. It'll come up again in the next slide because there's so much supply being delivered now. But importantly, there won't be a lot of supply going forward. So we expect these concessions to what we call in the industry burn off. And then, of course, there's just the natural, once you're leased, you typically don't have concessions on new renewals of leases. Maybe I should say it again, on lease renewals. So sometimes you offer concessions to fill up a property, but once you have the renter, your goal is to keep the renter. And that's why we measure renewal rates. If we ever talk about those, you want to keep the renter and you're typically not paying concessions there. So we expect renewals to not be so significant to cash flow going forward because there will be less supply, but B, as you lease up properties, that naturally happens as well. So currently we are offering 8 weeks of concessions here. That's in the market, that's what's necessary. But we view that as a one-time event. Operational leverage, here we're sharing management resources with Charlotte Noda, which is our QOZ1 asset in Noda, Charlotte. And so that reduces overhead and provides operational scale. And then when we talk about rents being below pro forma, again, our rents, we are always talking about our effective rents. The face rate rents are actually above pro forma, but when you factor in a concession of 8 weeks, when we had modeled only 4, that produces that short-term distortion, but we believe that's short-term. Northerly in Madison, Tennessee, Nashville market. Again, you're going to see the trend, 49 new leases since June. That's pacing 20 leases a month. That's at the high end of what we model. Rent dynamics. Here, this is a very heavily concessed market. So although we're above face rate and rents, this is actually a 3-month concession market. Again, we believe this is a moment in time, and you're going to see this normalize. I'll probably get ahead of the Q&A question, like what is a normal concession? Typically, it's 2 weeks to 4 weeks. I mean, that's what it's been in my 20-year career in multifamily. So obviously this is a moment in time that's quite a bit higher. So I wouldn't read much into that at this point, but we will continue to report out on that because it should wane into the next quarter or two. Operational enhancements, we transferred management. We're very active in that area, not only with selection of managers, but the teams themselves, property managers, leasing managers, even maintenance. We get involved in the hiring and evaluation process. Refinancing is in progress. And here we have a 4.9 star Google rating, which, we've talked about this in the past, but online reviews are really important because they help shape the buyer process of selecting properties that they want to tour and eventually rent. So we spend a lot of time making sure that we outperform in that area. And then suddenly at Terrell in Austin, Texas, this is a preferred equity position. And another example of how we've managed risk and valuation process throughout. So this particular deal needed a loan extension. It attained that, a 2-year loan extension. And in the process, because we're preferred equity in this deal, we have certain rights. And some of those rights include, we have to approve any loan extension because they're the senior loan. They sit above us in the capital structure repayment. So we took that leverage and we negotiated with the equity and they wound up putting in significant more equity, making our position even more safe. And these are the types of things that we could write up the asset because more equity makes it more likely that we'll get repaid. We really haven't. And here's an example where, yes, we moved to Altus and we're enjoying the process of working with them. But 2 things happened when we moved to Altus. The first was they corroborated our methodology. In other words, we were doing it in the best manner and the best practices. And then the other thing we saw was they're actually a bit more aggressive with how they underwrite than we do. And so had we wanted to, using their valuation strategies, we could, and valuation policies, we could have written up the share price more. We just opted not to. We want to be more conservative. So this would be an asset where we could have written it up more and didn't. I'm going to transition to market updates. But before I do, I just want, if I didn't cover any asset you have interest in, please just queue it up in the Q&A and we can talk about it. Okay, so in terms of the slides, how I want to process this portion, and I'm going to be relatively brief. I'm only going to be at 10 minutes here. First, I want to provide the frame of what creates value in real estate. In what we do. And typically there's 5 variables. And you don't have to remember these, but I'll go over these one by one. But one is obviously rents, one's operating expenses. One is the cost of interest because we do have to borrow money to finance either construction or long-term debt. The other is cap rates because that's the multiple on our earnings. And then in construction costs. Also come into play. And I would add maybe duration to that as well. And so I just want to kind of take you through that frame because I'll get to my conclusion and why I'm doing it. But let's start with just the asset class itself. And Michael touched on this relative to our fund. So what he said was, you know what, IncomePlus, we actually had really good returns in 20 and 21 when there were good returns to be had. And then when it got to be a recessionary environment, we had relatively better returns than others. And that's kind of what you want. You want a manager who can capture upside, but also protect in the areas that when it's more difficult. I would tell you that the asset class itself, and this is why we picked multifamily, also does that. And that's what this slide is showing. If you look at the blue versus the gray is all real estate. The blue is just multi. The blue tends to go higher when the market goes up and not down as much when the market goes down. And you'll also notice, just in real estate in general, it kind of doesn't go down that much, right? It's a fairly That would be my conclusion from this slide. Is one, real estate as a whole is actually usually on the upside of zero, but even within that, the blue, it tends to outperform in both directions, and that's not normal. It isn't normal that you get a higher return and a lower standard deviation at the same time. Usually you have to pick. So I'm going to start addressing the frame of what creates real estate value. And the first part of the frame, I believe, are just rents. What causes rents to go up? And what causes rents to go up is when there's more demand, more renters who want to rent than supply. Pretty simple. And what you're seeing here is on the supply side. So why do I think that it's a quarter or two in this whole idea of concessions that we talked about when we were talking about the properties themselves? Why do I think that that's not going to last long? I don't think it's going to last long because all the supply that's been hitting, and you can see it quarter by quarter, it's really dropped off a cliff. And that shouldn't surprise anybody. Supply takes 2 to 3.5, 4 years at the most from breaking ground, depending on the construction type. And the Fed started raising rates in 22. So a lot of the supply just stopped or was delayed, or they looked at it again and the deal never happened. And that's what you're seeing in this graph is the quarter-over-quarter pretty significant decline in supply. And you have to put that within the frame of this is in a nation that doesn't have enough housing. It'd be one thing if supply was declining, but we had an overbuilt housing structure, but we don't. It's actually the opposite. Depending on who you cite as a resource, it's anywhere from 1.5 million to 4 million units of shortage. And this is a bit redundant, but it just, again, points this out. These are multifamily starts. And, not surprisingly, you see that the slope really starts to go negative and crater in 22. And that's what's been happening. New permitting is down 37% from peak in 22. And so, we're in the middle of this transitioning of a lot that was built in 21, and that's all being leased right now. But then it's going to move to an area where we have more demand than supply. And this is what's causing a lot of the demand. Now I'm moving to the demand side of this conversation. It's just much, much more expensive to own than to rent. And how much more expensive? $1,000 a month, $1,100, $1,200. I mean, this is significant to most families. That's a significant amount of money, or most people starting out, recent college grads. Even anecdotally, I just know an awful lot of young people that have great college degrees and good jobs, and they want to buy a home, and they're having a lot of difficulty doing that because of the high interest rates, because in many parts of the country there hasn't been a correction in residential housing. And then a lot of the inputs like insurance have gone up a lot. So it's very difficult to join that home ownership group. And what you're seeing on the home ownership side is the median age of home ownership keeps going up. And that's something that we probably need to address as a country, but this is about making money. This is about IncomePlus. This is about what we do. Our demand is really through the roof in terms of people that are making choices to rent. It's really among the highest it's ever been. And until some of these things change, I don't see how it just doesn't continue to go that way. So I'm moving here to another input, which is construction costs. And this is really relevant to the IncomePlus because IncomePlus develops. We have a development portfolio, and we'll continue to develop. As those become stabilized, we'll do more development. And one of the reasons that I'm so excited about IncomePlus going forward is development. It really should get 15 to 25% IRRs. And I say that because, Michael and I have been developing since 2011. And in normalized markets, that's what you do. Our track record is 15 to 25% for 10 years. in this fund, it's underperformed that because to date, because all these variables actually went against you at the same time. It's pretty remarkable. We had interest rates, cap rates, construction costs, OPEX, and rents all go against us at the same time from 2022 to current. And in that period, we still made money in development. But that shows you, it's sort of a fortress, the way we develop. We had a lot of things go against us, and we still made pretty good money. Well, what's going to happen when that's not the case, right? I think it'll revert back to what we did the 10 years prior. I can tell you this, we're not worse at developing than we were in 2012. We're better. And we have a better team, and we have more experience, and we have better access to deal flow, and we have better processes. So that's not it. It's vintage and it's market environment. So I believe that the development sleeve will start to really augment our returns significantly going forward. But in terms of construction costs, they have stabilized. You had this massive increase coming out of COVID, supply chain. We lived, I won't be redundant, we all know this. And then once that happened, over the last really 2 years, you've seen almost no increase in construction costs, including, by the way, everyone's fears about tariffs. We're just not seeing it. We have plenty of very experienced construction managers within Origin, and we do a quarterly report on construction price. It's by region because a lot of the regions are different. The Denver region is a different pricing than the Southeast. So just simply to say construction pricing is here isn't right. And so we have very detailed analysis, and we're not seeing it. We're seeing a very low to flat construction inflation. And the reason is pretty intuitive. The GCs just aren't busy. The general contractors and the subs, when starts and permits go down 31 and 37%, they're not busy. And so they're willing to take jobs for much lower margins. And that mitigates any input costs from a tariff line item. So SOFR is trending lower. We know this. It peaked at 5.25. Now it's 4.25. The Fed 2 days ago signaled that they're probably going to cut in September again. The market expects probably another cut, maybe 2 by the end of the year. I'm not going to opine on that. If you made me opine, I would say 2, not 3. But that's neither here nor there. The point is, one of our inputs is borrowing cost, and it's trending our way, which is good. That means when we're in the construction phase, we get to borrow cheaper because those loans are priced over SOFR. It isn't always the case, by the way, that when the Fed cuts rates, the longer end of the curve follows lower. That doesn't have to happen. In fact, the last time they cut rates, the curve inverted and the 10s winded up higher in yield. So far, nothing's happened since that. Interest rates aren't higher or lower at the 10s, because that's really the 5s and 10s are where Michael and I really are measuring borrowing exposure, not the Fed funds or SOFR rate. And then cap rates have stabilized. This is a very long dated chart, but if we really just focus on 21 to 25, it would look a little bit differently. Cap rates, because we lived it, cap rates were, 5-ish, and they went to 3.5, and then they went from 3.5 back to 5.25, and now they're drifting actually a little bit lower. Cap rates are a function of the market, the sub-market, the asset quality itself, the location. So again, you have to really get granular, but in general, in the growth markets with good assets, because that's what we either build or purchase, I would say it's a 4.6 to 5.1 market, depending on how good the asset is, location, quality construction, et cetera. And that's a little bit lower. It was probably 25 bips higher a year ago. So they are trending a little bit lower. And it's because there's so much capital chasing multifamily, because probably what people are realizing is how interesting the asset class is from a supply-demand standpoint right now. And I think we went over that. So that is it. The frame of that, the 5 legs of real estate, if you will, when I go through them, the reason I took the time to do that is IncomePlus, it really touches all of it because it's a multi-strategy fund. And if you start thinking about all of the legs, I'm really bullish on where we are, and I'm not surprised Michael increased his allocation. Michael, do you want to take the first question?
Yeah, I'll give you a little breathing room here, Dave. My screen is spinning. Can you see me and hear me? Dave, are you there?
Yeah, sorry. I can see you fine. I can hear you fine.
Okay, great. Yeah, I'll give you a little time to rest after that one. David asked the question, how does the big, beautiful bill impact the valuations of properties in the portfolio? David, the answer is right now, it doesn't. We haven't seen any impact whatsoever. The only thing the big, beautiful bill did in real estate from our standpoint is provided clarity on QOZ law. So it's really too early. Multifamily real estate performance is really about population and job growth and quality job growth on that side. So to the extent that it leads to more jobs in this country, it will be a net beneficiary of that. But those things take time to roll out. Dave, I'll grab another question for a second. Mitchell, I've been reading about a resurgence of the housing market in Detroit. Mitchell, we do not invest in Detroit. So we do live in Chicago, but we don't even invest here. So our entire strategy is sort of Sunbelt growth markets, business-friendly states.
Hey, Michael, take the next one because I think there's a fire alarm going off in my office. Okay.
Okay, I'll keep going. Yeah, I heard something in the background. James, thank you for participating today. I see you've been really busy in the chat, asked a lot of great questions. I also think that it probably makes sense to set up a call. If you want to contact me or David, my email is michael@origininvestments.com, or you can contact David at origininvestments.com. And that really goes for anybody on this webinar. If you want to reach out, if you have a question, if you need more information, we can get that for you as well. So you want details on the leverage, both the cap stack into which you are lending, right? Great question. And please reach out to me and we will send you the latest quarterly report, which has all the data and information you could possibly want. James also asked the question, what is the tax part of the current distribution and the total return? James, I believe I answered this, but I will just maybe go into it a little bit. But the tax part, the only thing that you would be taxed on in this fund is the distribution yield. Much of that is shielded, though, by depreciation. I went over that. Any appreciation that happens in the unit price. So it's no different than buying a stock, but you would have to pay taxes once you sell, just like you would in a stock. So if you buy it at $11.17 today and it grows to $13 in the future, you would be paying capital gains tax on the difference between those two prices. Bruce asked the question, about a year ago, you were talking about a pivot towards development, but it doesn't look like there has been much of a change. Am I reading this right? And if so, where are we going to get the capital to devote to development if money is slowly coming back? Good question, Bruce. The answer to that is yes, from preferred equity investments paying off. It's going to be from new investments coming in, and we started to build a cash position in the fund. And lastly, we are actually selling Monroe and Aberdeen, which is what I would call a non-strategic asset. When we opened this fund back in 2019, Chicago was a target market for ours. We didn't cross it off the list. It is no longer today. So that asset is sort of a standalone, non-strategic asset that we're selling. And that we're working through that process now. I'm not going to say it's under contract, but money isn't hard. So until people go hard with money, we can't, there's a 50-50 chance of that deal closing. So that would also bring a significant amount of equity into the fund to recycle into development. But make no mistake about it, that is our priority, is that we are acquiring these sidecar interests first, shoring up the fund, I would say, with cash position. We've already done that. Then we're buying these sidecar interests, which are quasi-development. They're in lease up. There's a slight edge to those. And then we're investing in new ground up development as well to maximize the returns of the fund.
Thanks, Michael. I can take over.
All right.
It was a false alarm. So James asked another question. I'll tell you what, I'll take two and then we'll just start alternating. All right.
Yeah.
Do we use third parties to derive our NAVs? Yes, we do. That's a new change. We use Altus, and Michael covered that a little bit earlier. But yeah, we've made that change. Some of our largest investors really asked for that, and we said, no problem, we'll do that. We made that switch. In the process, we sort of found out that we're more conservative than the outsourced market leaders in this space, but that's fine. We can now unequivocally say, yeah, we just outsource it. James asked another question. Does the IncomePlus Fund have a DRIP? Yes, it has a DRIP. The whole idea, and Michael covered this, of owning long-term, we want you to view this like a long-term fund. The wealthiest people throughout the world, they own real estate for generations, and this fund is kind of designed to allow you to do that. And it's a tax efficient way to have that exposure for long periods of time. And yes, you can invest in the DRIP or not. And the other thing I would add, James, is when you become an investor, you make an election. I'll be in the DRIP or I won't. You can change it. If you change your mind a year later and say, actually, you know what, I kind of want that 6.5 dividend, that I need that at this moment, then change the election and you'll receive it, and then you can change it back. And so I actually did that in this fund. I signed up for the DRIP. I'm sorry, it was the reverse. I signed up to get distributions and then changed my mind, and now I do the DRIP.
Thanks, Dave. James asked the question about the monthly total return changes in estimated NAV. That's correct, James. And then, yes, you asked about the accuracy, transparency, validity, the realism in the NAV. Yeah, and I would say that's crucial throughout the industry. We've seen that certainly with Blackstone, a lot of the redemptions on their side. They were in the paper for valuation issues, I would say, like maybe people weren't believing that. So it's really, really important that anyone investing in this fund signs off on the valuations, because when you're buying in at $11.17, essentially what you're buying into is the fair market value of the assets at that point in time. So in a private fund, we have the benefit of the fund value equals the net asset value of the underlying assets. In a public REIT, the stock price can be wildly different than the actual underlying NAV of the assets themselves. But we talked a little bit about Altus Group. We've moved to that model. Didn't impact the valuations of our properties. It's just more frequent now that we're doing the valuations. Okay,
I'm going to answer James. Great question. Why do you keep this private? Why not take it public? A couple reasons, but the biggest of which is this is still a relatively small fund. The total NAV is not so great, and being public is actually quite expensive. And you as investors, I should say we as investors, because Michael and I are very large investors, we cumulatively bear the brunt of that. And so in general, I have always made, and this is me, I've always made my most lucrative investments owning private assets for long periods of time. And that's not to say that's the only way to do it. There's a lot of different ways to get to your goals. That's been most successful to me. So it's high dividend. And in terms of just the trends in the industry, this idea of public and private is getting very, very gray. We're about to launch, it's not launch, but we're making our strategic credit fund an interval fund. And all that means is it comes with the governance and the liquidity requirements that make it start to look like a public stock, even though it's still a vehicle for private investment. And that shouldn't surprise you. I mean, if you think about just the trends in the stock market, there's just a lot less stocks than there were 10 years, 20 years, 30 years. And now there's many, many more private equity firms and private market transactions, both in debt and equity. So it's becoming very blurry. We're very satisfied with the structure of this fund and what it provides. And we think it mitigates the areas that people, and by the way, your questions are hitting on these. What you're really saying is, hey, it's private. How is it valued fairly? And the answer is yes. It's externally valued, and it is. Another question would be, well, do you have liquidity? And we've proven through this, difficult recessionary environment that, yeah, we had ample liquidity. Not many people redeemed, first of all, out of our funds at all, because we were doing quite well, certainly on a relative basis. But for the ones who did, they all redeemed. That wasn't an issue. But these are all things that we as managers have to answer, and they're good questions.
Dave, I'll grab questions 11 and 12. William asked the question, how agile can you be as the fund grows? We can be agile, William, because, like I've thought about this question, and this is a good question. We get it quite a lot. As the fund gets to, it's $540 million today, as it gets to $1 billion, $2 billion. If you think about just the development sleeve within the portfolio, at $1 billion, you're talking about $200 million. You're talking about, maybe 5 deals a year, and we do far more than that in the development sleeve. Today, it's actually more difficult to run a smaller fund. But I think when it comes to tilting the fund, I see development always as, a core part of our business in this fund, is that high margin sleeve. So you're really talking about the common equity, core stabilized deals, and then the debt on that side. And it all comes down to, where do you allocate capital during parts of that cycle? And we just went through a very extreme situation where we tilted the fund heavily towards debt. Hopefully we won't see something like that again in our lifetime. But if we had to, like, shifting $1 billion fund, $200 million or $300 million in one direction, shouldn't be very, very difficult, because you're not talking about a large number of deals to do that. You're talking about, the difference if you have preferred equity that pays off, 2, 3, 5 deals, and you shift all that into common equity, you're talking about buying 4 or 5, maybe 6 deals in a fund like this. So I see that, at $1 billion, we're still agile. At $2 billion, we're agile, but certainly, it's harder to turn a ship once you start getting into $2 billion and $3 billion. But the idea isn't to turn this into a credit fund. Like, if we see storms on the horizon, the ability is to tilt these buckets a little bit, right? Instead of being 60-40, maybe we're 80-20, or maybe we're 50-50 in these directions, and continue to just manage the fund over time in the best way we see possible, and invest new money in the highest risk-adjusted investments out there. Stephen asked the question, will the tilt towards equity from debt have an impact on the fund yield? Stephen, no, it won't. If anything, it'll have an impact on the tax efficiency of the fund, which is a good thing. It'll become more and more tax efficient. So even, to get into the details of how a REIT operates, if we have more depreciation than what we can use to shield 100% of the distribution yield, then that gets trapped at the REIT, and we can use it in the future so that we can continue to operate the fund in a tax efficient manner. But that won't impact the distribution yield. The thing that will impact the distribution yield is the unit price, because the distribution yield is a function of how much we're paying out, and it's not targeted at 6.5%. So if the unit price goes up to $12 or $13 and we're still paying out the same amount per unit, you'll see that distribution yield go down to, below 6%, and it's been 5.5% in the past. So that's what will really change that distribution yield for new investors. But today, if you invest, you're going to be around that 6.4, 6.5%.
James, I'll just take this one. James, thanks for your question. His question is, when we're sourcing new deals, are we originating independent deals, or are we developing, buying, lending to assets that we own? When we source deals for this fund, they're independent deals. We don't lend to other properties or develop properties or co-own across funds or anything like that. So I'm trying to answer your question. I'm being brief because it's a yes, no question, and the answer is they're independent.
Dave, I'm going to start from the end here so we can kind of work towards the middle. So I'm going to start with question 49 from Manan. He said, sorry, I may have missed this earlier. Are you seeing additional tax benefits for housing on the horizon that the IncomePlus Fund can leverage? Manan, the answer to that is no, but what we are seeing, and this is really as a result of us spinning off our credit side. It's not spun off. It actually has a little more oversight because it deals with securities. But something we're going to be bringing in the fund in the next year is just a more robust debt platform. So we will actually see the returns on the debt side and new debt instruments that we're putting in there return or increase as a result of getting just better leverage, better deals, and leveraging the team on the credit side that's based out in Denver. So there are good things, but nothing has changed really on the tax side.
James asked a question, what percentage of the fund is owned by institutional investors? The answer is 0. This fund is for people like us. It's for people that have gotten ahead in life and want all these benefits, et cetera. We do have quite a few investment advisory firms as partners. I believe over 100. So on that side, but I view that more, and I know you do too, Michael. We view that more as that's just a relationship with an investment advisory firm that has clients that also look like us. So we're talking to them rather than the client, and we value both. So it's really one of those two things. And then if you say things like, you hear this a lot, oh, and then we have family office clients. Yeah, we have tons of family office clients, but again, those are also people like us. They pay taxes. They've gotten ahead in life. They want to shelter their earnings, make it defensive, but also reap the benefits, right? Protect the principal and then let the upside run in a tax efficient way. So that also transitions into your next question, which is, again, James, what's the minimum? How do you invest? And Michael, you have to answer the question about the minimum because I actually don't know off the top of my head. I think it's 50,000, but is that right?
Yeah.
Is that right? Okay.
Yes.
It's 50,000. Thanks. But I will answer the question about should you invest directly or through an RIA. That's up to you. You know, we have both RIA and direct clients, lots of them, and so we welcome both. Is the answer. So I can't answer that. I don't know if you want to add to that, Michael.
No, all good. I'll grab 2 questions here, Dave. Mitchell asked a question. You mentioned the strategic credit fund that you were developing. When do you anticipate taking investments? Mitchell, I think you're asking, Dave made a comment about the strategic credit fund converting to an interval fund. That's going to happen on September 15th. It's actually an existing fund. It's been existing for the last several years. It's just taking a form of more of a public entity that's going to be accessible through a ticker. John asked the question, it seems to take a long time to get K1s from some of the funds. Is that normal for these kinds of funds? The answer is yes, but John, the most important thing with this fund is that we are no longer a K1 fund. We are a 1099, and the goal is to get these out by the end of February. So this was a 1099 for the first 4 years of existence, and we recently converted to a private REIT to simplify it for investors and RIAs, and because we know that's a huge pain point for people.
I'll take 20 and you can take 21. Yuri, thanks for your question. Email me. He wants to know the details of the Raleigh Charlotte financing terms. Email me at david@origininvestments.com and I'll put you in touch with our head of investment management. So we'll get back to you on that. Go ahead, Michael.
Paresh asked the question, can you please speak to the preferred equity portion of the assets and how they are performing in aggregate? Also, any insight into future trajectory of returns from that portion of the fund? Sorry, my eyes are getting better or getting worse as I get older here. Paresh, again, we can send you the quarterly report. That would be easiest for you to kind of dig into that. Preferred return, the preferred equity portion of the portfolio, we have, I believe it's 3 deals that have accrued above 90% that we've stopped accruing, but the rest of the portfolio is performing quite well. But please reach out to either David or me, and we will send you the quarterly report that has a lot of data and information about that part of the portfolio.
James asked a question, with Southerly, is the LTV cap LTC or LTV? It's always based on value, because obviously value changes over time. These are investments that move through time and change, both for the good, the bad, et cetera. So we do it based on current value.
Paul asked the question, do you allow self-directed IRA investments, and is this investment appropriate for that, given that it is so tax beneficial? Paul, we do have people who invest through an IRA in the IncomePlus Fund. I'm not an advisor. I have to say that my compliance team is going to look at this, so I have to caveat that. Generally, if you're investing through an IRA, you want to invest in investments that aren't tax efficient. This is incredibly tax efficient, so I would say that it's not inappropriate, but something like the Strategic Credit Fund is probably more appropriate, because you can produce, we generate around the same types of returns, 10-11%, with lower volatility. And if you're not paying taxes, you're going to ultimately get to the same benefits. So this is real estate is a great fund for kind of after-tax non-IRA money.
Nick, thanks for your question. He asked, what's the best cash flowing market in this fund? I think what he's asking is, what's the highest dividend provider in the fund, like what firm? I don't know is the answer, who provides the highest dividend. Ours is pretty high, and we've only increased it over time. And it's also paid, since inception. So pretty proud of that. The other thing I would be much more concerned with the overall returns, not just the cash flow through market cycles, because sometimes very high yielding investment opportunities are there because they're high risk as well.
Brian asked the question, do effective rents being below pro forma reflect on the accuracy of Multilytics, or how do you square the two together? Brian, I would answer that saying no, Multilytics is accurate. We've also been through one of the most volatile periods. I don't think there's any, and I know this, right? There's nothing that's been more accurate during that period. And certainly there's other variables that go into the valuation. So I assume you're talking maybe about some of the sidecars that we bought into the portfolio. But overall, when we look at our returns on assets that we invested in 21 and 22, all of them have generated positive returns. So we don't always adopt the Multilytics framework within ours. So a lot of times we will use that as a guide, and we'll be more conservative on that. But there's a lot more variables that go into forecasting the valuation within properties and the variables that go into that. So Dave, I don't know if you want to add anything there. That's question 43.
No, that's fine. Yeah. I can answer, and I want to be respectful of your time. We're trying to balance. There's a lot of questions, but maybe we'll do 5 more minutes, and we really appreciate your time as well. We want to keep it to an hour. It's an hour 4 right now. Kai, thank you for your question. Last week, the government reported strong multifamily starts. I saw that too. Is this a signal of it changing, and that whole narrative of supply is limited is changing? No, that was a blip, and there's a lot of articles on this. Like you can't use, and I don't want to be political, but it's just not. It's not done in a way that's conducive to multifamily data collection, the way that this process is, and so you really have to look at it over a trended period. I would welcome you to read, Jay Parsons has written many, many blogs on this, including one last week. And I think he's quite good. So if you have a moment, Google him and the blogs will come up. But no, the short answer is no. And what I can tell you, because, my teams and I are in the markets on a daily basis, it is not increasing. Supply is going to be a real problem, and it's not getting better. It wasn't better in July. It's not better today.
Dave, let's go lightning round. Take a little page out of Kramer's book here. I'll grab 3 questions quickly. You grab 3, and hopefully we can knock 95% of these out. TS asked the question, is the long-term plan still for the fund to acquire Azola? Yes, we love that asset. So hopefully, I'm assuming you're in that. Greg asked the question, does the IncomePlus Fund accept a 1031 exchange? Kind of, it does. So part of our new DST program, if you have a 1031 exchange, we do have investments available that ultimately will be acquired by the IncomePlus Fund, but it's a 2-step transaction. You need to sell your asset, put it with a qualified intermediary, invest in one of our properties that will ultimately be uprooted into the IncomePlus Fund. Brent asked the question, the Sunbelt cities are growth markets, but the concern in most growth markets is that unconstrained supply may continually overwhelm demand. Could you comment on that? Brent, supply is one side of the equation. And I think if there's anything I've learned over the years of my real estate career is that, the more people build, the better markets get. And Dave and I'll never forget this. We were down in Nashville 10 years ago, and we were scared by all the supply coming in, and we didn't want to invest there. And the city is totally transformed and different today. And, I'll never forget, like, they were increasing the supply by over 100%. And the headlines 3 years later were they can't build them fast enough. And so we've seen this in every city. And so if we're going to be betting on multifamily and investing, you want to bet where there's going to be population growth, where there's job growth, where incomes are increasing. So supply and demand is a very nuanced. It does ultimately rule. And right now supply is winning and renters are having a great, renters are getting a great deal. But we're thinking about these investments as 5, 10, 20 years down the line. And we think these are the right cities to be in.
Michael, thank you for your question. Please explain how you determine where a deal goes between IncomePlus and strategic credit. So IncomePlus, first of all, does things strategic credit just doesn't do. All the development is only IncomePlus. All of the equity ownership of buildings that we operate, only IncomePlus. When it comes into the credit sleeve, which we want to say is anywhere from 40 to 50%. Right now, it's a little bit higher in IncomePlus. Both funds can do similar things, but I wouldn't look at it from the glass half empty. I actually believe it's half full. The way I look at it is because strategic credit has created this amazing infrastructure within both publicly marketed multifamily securities, Freddie Mac B pieces, et cetera, plus the issuance of construction loans, bridge loans, et cetera. That's a very difficult and sophisticated business to break into, and it's done it, and it's become a market leader in it. Now IncomePlus actually has access to those strategies that it actually didn't even have before. And so I really view it as, again, like when I'm looking at IncomePlus, it's benefiting both from the infrastructure that was created on that side and the deal flow. How do you get good deals in credit and equity? You do it by being active, by doing deals, by getting the first call, by having the relationship. I mean, that's how it works. And, I really think IncomePlus will benefit from what Strategic Credit Fund does and vice versa, because there will be times where strategic credit needs equity and maybe IncomePlus has it, and you continue to roll through time. So I view it as a very positive thing. The second is Brian asked a question. I'm supposed to be doing 3, I think. Net migration. So Brian, this is a long question, but when I read it, I don't know if you're saying migration into the country, meaning the U.S., or migration from New York, Chicago, San Francisco to the Sunbelt growth markets. Is it an interstate? Is it national? Just reach out to me, David at origininvestments.com. Happy to have the conversation offline. And then my third, I'm on 30, Michael. I know you skipped ahead.
Yeah, I'm on 38, coming down to me. So we're almost there.
Okay. Shim Shan asked a question. Thanks for your question. If good deals don't seem to be selling for more than 5.75 caps and barn rates aren't too much lower, where are the opportunities? I tried to cover that in my section about cap rates. Good deals are selling at 4.5 caps, not 5.75. So, if you look at great real estate and great markets with great growth, 4.5, 4.6, 4.7. And so that litmus, you're right in determining it. Like, wait a minute, you should be borrowing always less than your cap rate. You could also look at the same thing and deduce, wow, the fundamentals are so strong that long-term holders are just willing to overlook this. And that's what's happening. And basically, they're in these instances where 4.5 cap trades, they're just saying, look, I'm going to buy it unlevered with no debt. And I think rent growth is going to be 5% for the next 5 years. And I'm going to grow into an 8 cap in an amazing location, right? So you're not wrong in what you're saying, but you can make different deductions with that. Do you buy a P of 11 in a negative growth industry, or do you buy a P of 50 in a high growth industry? People do both.
Okay, Dave, I'll grab a few questions. Thomas asked a question regarding the buying the sidecar interest in the fund. How was valuation and timing determined such that it was fair to both sidecar investors and Origin IPF investors? Thomas, I'm going to assume you're in the sidecar, maybe not just in the fund. When we do sidecars, this is all kind of done in advance. When we're going to buy these, generally it's when the asset is developed going into stabilization, so that the fund does get a small edge. And that process is done through an appraisal. So third-party appraisals create valuations, and then we go out to investors and they make the determination whether they want to convert to the fund at that price or actually stay in the deal until we can get them out for cash in that fund. So hopefully that answers your question. Nick asks, are there any sidecars coming in the pipeline? Great question, Nick. We always have sidecars that we're talking about, looking at. There's nothing right now that's imminent, but please reach out to whoever your investor relations contact is, or David or me, and we'll put you in touch with the right person to make sure that you are on the list for that. Tom asked the question, how does the drop off in immigration? Dave, you sort of answered this a little bit. Tom, the immigration right now that is impacted by Trump, that's not our demographic. We really go after a Class A renter, somebody who we call a renter by choice, has a college degree, very high levels of income, $80,000, $100,000, $150,000, $200,000. So that's not going to show up right now. The immigration, like if the net migration does stay like this and we continue, this could show up in 20 years, but right now it's not having an impact.
Am I up?
Yep, you're up.
All right. So Michael, thank you for your question. I think you asked a similar question that I answered before. On new deals, we don't lend or share assets with other funds or anything like that. I think that's your question you're driving at. The second is, what keeps you up at night? Thanks, Al. Good question. I'm concerned about our national debt and our deficits. I have been for a long time. There's been a lot of papers written, interesting enough, 20, 30 years ago about how debt to GDP can't exceed 1-to-1. And if it does, it's not sustainable and things start to break and we're at 130. So I'm worried about it. I can't do anything about it, but that would be what keeps me up at night. Just in general, what I worry about are things we can't control that affect our investment returns, right? That would affect our investment, but I can't control it. There's a fire alarm. You gotta go yourself.
All right. Well, hopefully it's just it's not a real one. So testing your building. Rob asked the question, how has your AI rent projection model performed during real estate recession? What does the model projection look over the next 5 years? Rob, reach out to us. We will send you a comprehensive analysis on Multilytics and anyone else who wants that as well. We do back testing every year. We do forward projections. We have that. It's just too long of an answer here, and I don't have it all in the top of my head, but we'll get that to you. Thomas asked the question, any plans to allow partial drip in the future, take a portion of the fund's returns as a distribution while reinvesting the remainder into the fund? Thomas, I'm not quite sure I understand that question itself, so reach out to me, and I'm happy to answer that. So, okay, well, that is it. We are an hour 15. This was supposed to be an hour. Thank you, everybody. We really appreciate your time listening, staying here all the way to the end. Thank you again. If you are an investment partner of ours, if you're a prospective investment partner of ours, this is what you can expect. We do these webinars on a regular basis. David and I always make ourselves available to talk to people. Reach out to me, Michael at origininvestments.com. Reach out to Dave at David at origininvestments.com. And again, a big shout out to my favorite attendee today, my son. Thank you very much, everyone. And we'll talk to you soon.
Bye, everybody. Live TV. Have a good day.